Hello, how is you? Yes, how are you? So, you have a suggestion? We go back to basic financial accounting. Financial, financial accounting, and as per your list, the first one is to define, to understand the nature of accounts. To understand the nature of accounts, the nature of account, and to say the nature of account, or the nature of accountings, nature of what? The nature of accounting, the nature of accounting. Because tulisema we have two terms, we tuko na finance and accounting. So we are accounting the finance. So and we say accounting is about what? Keeping the records. Accounting is about keeping the record of finance, keeping the records. So if you look at that list, it is about the background and main features of financial accounting. So it is not something big, it's only that they are using different phrases, but the main features of financial accounting, you will talk of mostly three: the objective, and then two is external, the external focus. External, the objective and external focus, the objective and external focus. And also the historical events. How do we write events? Yes. So when we talk of accountings, you need to have the objective. And then now after objective, we come to the external focus, and then we come to the historical event. We have talked about the objective of accounting. Why do we need this accounting? Or even if you are running a company, or you are the shareholder of a company, why do you need a bank ledger account? Why do you need bank ledger account? Why do you need the income statement account? Why do you need income statement account? Also, why do you need the valuation of the asset if it is a motor vehicle? Or why do you need inventory? So that's what we refer as objective. So these all objective we are talking about, it is what? To help you to make a decision. So it is purposely for what? Decision making. It is purposely for what? Decision making. It is purposely for decision making. Uh, you have called me. Is there any challenge? Yes? Mm. No, I was just explaining, rushing all the way to that part. We start from material balance, which is good. So I was talking about decision making, and then when we talk of external focus is the who needs these financials, and we say the people who need these financial are what? Suppliers. We have customers. We also have the government. we also have the government, because they are interested to know whether we are making profit or loss, so that they can take their percentage. And also, when we talk of this accounting, we are talking about these are historical event. We are recording a transaction which has already taken place in past. It is not about the future. So if it is about the future, then now the financial forecast ndio inakuja, but now accounting is always about the past. It's always about the past. So it is good that you've said you are suggesting we start from I've seen another thing which is very important there also, the effect of profit or loss on the capital and the double entry system for expenses and revenue. So if you look at that statement, it is putting it in a long way, the effect of profit and loss on the capital and revenue. So what will happen if you make a loss? So what will happen if you make a loss? So if you make a loss as either individual or the company, it's always affect the capital account. It's always affect the capital account. Also, if you make profit, it always affect the capital account. It always affect the capital account. So if you make loss, it will reduce your investment. It will reduce your investment because you are incurring expenditure which you will not recover that expenditure. You will not recover that expenditure. So on the side effect of the capital will what? Will decrease. The capital will decrease. What about the profit? What about the profit? If you make profit, you will not going to use all of your profit. Maybe you will not, if you make a 10 million, you will not use all of the 10 million. No, maybe you will use like 5 million paying dividend to the shareholders. You remain with 5 million, which that 5 million in accounts, we call it retained earnings. We call it retained earnings. This retained earning is the one you take back to the capital account. You take back to the capital account. So you'll find that the capital account now will go up. The capital account now will go up. The capital account will go up. The capital account will go up. So those are it's just they are using a lot of sentence, but it's just a double entry debit and credit. And then we also have the balancing of accounts. That thing they are balancing of the accounts. Balancing of the accounts. You don't leave a ledger account hanging. You don't leave a ledger account hanging. You should close that account. So an example here, balancing of this account. An example, you put a motor vehicle with a check, maybe check 00567 worth 5 million. This is a motor vehicle. This is a motor vehicle. You have to record that transaction. You have to record this transaction. You put a motor vehicle with a check, or you wrote a check with 5 million. So you will open the motor vehicle account, which you are increasing the assets. So what do? You debit the bank account 5 million, and then we will have bank account here. We are reducing the assets, which is bank. So we will credit motor vehicle account 5 million. We will credit the motor vehicle 5 million. So we will not leave this account hanging like this. We will not leave this account hanging like this. So that's why if you leave this account hanging like this, you will get your trial balance, it will not balance. That's why you find most of the people, they have what is called the suspense account, which it as a result of these errors zenye mtu ameignore. So you must close this account. So balancing off is just getting the balance carried down here. If there is no other transaction on the debit side, it's just getting the balance carried down here. So you will find that this is a bank overdraft. This is a bank overdraft because we didn't have the opening balance of the bank. So that's why we are using more than what we have in our accounts. So you should balance, which will come to your credit. And then also this one, you balance off. Balance carried down as 5 million. That's what it's mean when it say the balancing of accounts. The balancing of accounts. The balancing of accounts. Also, you will realize that when it comes to the reporting, this you will not report 5 million in the books of account. So when it comes to reporting, which we use the P&L, you will not report 5 million. You will not report the 5 million because once you put ukinunua motor vehicle, immediately it start depreciating. So if you find you go direct and report this one not in P&L, in balance sheet, in SFP, if you go direct and report motor vehicle, you say 5 million, your account will not, it might balance because that is error of omission. You omitted since the beginning of the transaction. So that one, your accounts can balance, but there is an error of omission. That's why unapata most of those error affect the trial balance. So you need to do adjustment so that you can adjust for the what? Depreciation. So you have to adjust for depreciation. So hizo ndio some of the balancing of accounts. Hizo ndio tunamaanisha. You have raised hand. You said so the only retained earnings will go to the capital. Yes, it is only the retained earning which will go to the capital, because if I have to get my capital account here, if I have to get my capital account, which the capital account, when it comes to reporting, we use the statement of changes in equity, but I don't want to introduce that one. Capital account. What will affect the capital account? What will affect the capital account is the ordinary share capital, ordinary share capital, ordinary share capital, ordinary share capital, ordinary share capital. For a good, an example in Kenya, if you register a company, in Kenya, we have what is called the nominal shares. If you register a company in Kenya, we have what is called a nominal shares. Nominal shares. These nominal shares, I think in Kenya inakwanga 1,000 per share. It is 10 shilling per share. It's always 10 shilling per share, and for 1,000 shares. So if you register a company, it is what 10 shilling per share. 10 shilling per share, and you will be allotted 1,000 shares. You will be allotted 1,000 shares. So this is, we have the price per share and we have the number of shares. So you will find in total you will have the ordinary share value being 100,000. You will find shares are being 100,000. So this one is the one which we report directly under ordinary share capital. Under ordinary share capital. So if you take the newspapers uangalie the publish of financial statement, utapata this at 100,000. So most of the companies, they have 100,000, another one is 10,000. It depends with the type of the company. So upate, this one is fixed, it will not change. So that one will affect the capital. And then we have another type of capital. We have another type of capital called the paid up capital. Paid up capital. Paid up capital. This paid up capital may be ukiform this company, you are one of the the director, and then in between your company is doing well, and then another person say, can I be a director so that I can contribute certain maybe skills, experience, or any other kind of a business. So that person, you will say, now pay me 300,000 to join my company. Pay me 300,000 to join my company. That one we will call it the paid up capital. Also, it will affect our capital. Also, it will affect our capital. So you find that our capital now will be 300,000 and 100,000. So at the moment now we have 400,000, and that now we have now profit or losses. Profit or losses. Profit or losses. This profit or losses, it if we make a profit, maybe a profit of 10 million. If we make a profit of 10 million, the directors of the company, these two directors will decide. Can we pay ourselves all of this profit of 10 million? But the decision will be no, because if they take this all amount of 10 million, the company will go into a liquidation. They will not have the cash to run their operation. So they will say, let's pay ourselves 5 million dividend. 5 million as a dividend. As a dividend. So they will subtract 5 million from the profit of 10 million as a dividend. So the remaining 5 million, we give back to the business, or we blow back to the business the remaining of what? 5 million. You take back to the business 5 million. And this 5 million, we will not call it profit and loss. It is no longer the profit and loss because it is not for the current period. So we say retained earning. Retained earning, which means it is the profit from the previous financial year. So we call it retained earning. We call it retained earning. And that retained earning, it will increases our what? Our capital. It will increases our capital. And then another instance is you make losses. You make loss of 10 million. So if you make loss of 10 million, who will suffer this loss? The people who will suffer this loss are the directors, not employee of the company, not the bank of the company, not the auditors of the company. It is the directors, because the directors are the ones who source the capital of the company. So they will the one suffer expenditure of 10 million yenye wameinika. So this 10 million, it will reduce the amount we have invested in the company. So it will reduce the amount we have invested in the company. That's why if it is a loss, also we call it retained losses. So it will affect the capital account. Another one is drawings. Either cash or goods. Either cash or goods. So if you draw cash as a director, it means you are reducing your value of shares. Or the value of ordinary share capital. So you have to adjust this capital. Also, if you taken maybe you have taken inventory, the value of inventory will what? The value of inventory will go down, and if the inventory value goes down, the capital account will be affected. What do I mean if I say the capital account is affected? So this is all about the double entry. tuseme, let's say today you open a shop. Let's say today you open a shop. Grocery. So let's say you are opening a grocery. So umeenda Nikikomba ama wapi ukanunua fruits. Ukabuy fruits worth 10,000. Ukabuy fruits worth 10,000. So this 10,000, we will call it the so utapata for your account to balance, utapata you have the value of stock. The value of stock ikiwa ngapi? 10,000. Your value of stock itakuwa 10,000. Your value of stock itakuwa 10,000, and then which we will debit the stock. We will debit the stock value, which is inventory. We will topic the stock as the opening inventory, as the opening inventory. And then you will credit the cash. You will credit the cash account and also the capital account. Because hizi pesa umeitoa, this amount umeitoa from your own pocket, not from the company, because you are starting a new shop, grocery shop. So there was no business at the beginning. So it means this 10,000, it is from your own saving. So that's why we will not even credit the cash. We will not credit the cash at the moment. Because your business was not in operation. This amount inatoka your saving account. So ikitoka your saving account, we will debit the stock value, which is an inventory, and credit our what? Capital account, and we will debit the capital account. And then ukakaa ikafika lunch time ama asubuhi ukasema hii watermelon inakaa so fresh, wacha nitoe ngapi? Nitoe 2 ama ukatoa moja, and then this watermelon ukatoa 2 at a cost of what? 150. So ukatoa 2 and then one watermelon ina cost 150. So you find that at the end of the day reduce what? 300 shilling. Umeitoa 300 shilling. This 300 shilling will affect your capital. This 100 shilling will affect your capital. So the journal entry for this transaction will be, we credit the stock because we have reduced our stock with 300. At the same time, we are reducing our capital with 300. So you will debit the capital account 300. You will debit the capital account 300. That's why nikasema drawings account ina affect drawings of goods, it affect the capital account. So that was the first question. So you have said inakwanga 10 per 10,000 Yeah, I remember that. So imekuwa long sana nikiangalia those inaitwa aje CR12. So CR12 ndio iko na hizo nominal shares. So inakwanga 10 shilling per share, and you will be allotted 1,000 shares. Yeah. So yes, reduction in capital we debit. That's why I've debited this one. Reduction in CWF, kuna zile notes nilikuwa nimekupea nikasema an increase in capital you credit, a decrease in capital you debit. Then another question, what is the difference between the purchase account and inventory account? What is the difference? Inventory and purchase account. So what is the difference between the purchase account and inventory account? So it's almost, I know it is confusing. So when we say inventory account, this one is the current asset account. This one is the current asset account. It is the current asset account. And we said the current asset account are those economic what asset or economic things which we can use for 1 year to generate the income of the business, or to generate the revenue of the business. So we call it what? The current asset. And inventory, these are the goods. These are the goods we are purchasing so that we do what? We resell. So we are purchasing inventory or goods so that we what? We resell. So if we are purchasing these goods to resell, it means at the end of the day it will generate revenue. Revenue. At the end of the day it will generate revenue. That's why we are referring as what? The current asset. That's why we are referring as the current asset. Now, and then the cash we are using, to purchase these goods. The cash we are using to purchase goods is expenses. These are expenses. But these expenses we will not report directly under the expenses account, but instead we will bring in a new term called the cost of sales. The cost of what? Sales. The cost of sales. So this is the cost we incur when selling these. So for us to get this revenue, we incur certain expenses. These expenses, we call it the cost of sales, and that cost of sales is what is called the purchases. And that cost of sales is what we refer to purchases. That's why when you have the purchases, if you when you have the purchases, you do what? You debit the inventory account. And credit the cost of sales account, which this cost of sales account is the purchases account. So it is not the same. The other one is the expenditure. And the other one is an asset. And those are two different class of accounts. Yes, I can't hear you. Maybe because of this mic. So maybe I can unplug so that you can ask the question. I think it is okay now. Still, I can't hear you. I'm on mute. Bado sikusikii. Oh, I've seen the problem. Hello.
Can you hear me now?
Yes. The challenge ilikuwa nimeitoa volume kwa laptop. You were saying?
Then sales is an income account.
Yes, sales is an income account. So the revenue, we call it revenue. Cost of sales, revenue, cost of sales. So this one is an income account. And we say income account, we credit an increase in income you credit.
I was asked,
Yes.
I was asking about the nominal shares.
Uh-huh.
You said each is 10 shillings and minimum is 1,000.
Yes.
So, ordinary share capital, usually the value is 10,000.
Hmm? Yes, the normal shares. You look at the nominal shares. If you have that, they issue you with CR12. We have another one called what? They are around 3 documents. So I don't know if they have changed those policies, but I remember bado iko around nominal shares ni ile 10,000. I can refer it. So inakwanga 10,000 1000 per 10 shilling per share, 10,000. So ukiregister company which you pay 15,000 for registration. So I don't know how they calculate, but they will, if you look at that certificate of incorporation, they will not show it certificate of incorporation, but in we have CS12 and C, do you see 2? Yes, so they will integrate there and the people who own those shares. So is there, kuna swali lingine? Now trial balance is not that something that it has its own magic of understanding, but it is just the closing figures. It is just the closing figures. So assuming that you have like 3 accounts here. These 3 accounts, you have the sales account, you have the cash account, and also what you have an expense account. Maybe this expense account is what? Bad debt account. Bad debt account. So sales always have the credit opening balance of the sales, or if you make sales, it always have what? A credit balance. It always have the credit balance, which maybe umefanya cash sales ya 100 shilling. This 100 shilling is you debit the sales account, you credit the sales account and debit the cash account. So I will come here and say cash sales 100. Cash sales are 100. And then maybe natungeweka hata bad debt, we say rent. Let's just assume you are paying a rent, because bad debt is coming if you have a credit sales. So let's say we have the rent account. So because ukifanya sales, it is either you have the physical shop, maybe you are incurring some rent or electricity. So at the end of the month, maybe you pay a token of 100 shilling also, or 50 shilling. So you will come here and write cash of what? 50. You pay a token of 50. You will come here and say I've incur 50 shilling to pay rent, to pay not rent, ningeka electricity so that it can make sense. Just tuweke electricity account. So ukalipa token ya 50 shilling, this 50 shilling, it will goes out of the cash account. So here you will write electricity. Ngapi? 50 shillings. You will write electricity 50 shilling. So ukifungua trial balance, this trial balance is we are extracting the that's why inasema trial balance. We are extracting the balances. We are extracting the balances from the ledger's account. This so guys, make sure that you are liking our videos, subscribing, and also you are sharing our videos so that you can get more videos to come whenever we are alive. So make sure that you are doing that. I know you are good people. I don't want to remind you that